and welcome to Indianomics. Today's edition paraphrases the key takeaways from this year's Jackson Hole Economic Symposium. This symposium attracts the most powerful central bankers and economists and is watched by financial markets for guidance on how the world will move on and how the Fed will act. In 2012, Ben Bernanke had signaled QE3 from the Jackson Hole Symposium. This year, the world wants to know if the Fed will hike rates in September. Let's catch up first with the conversation that CNBC's Steve Leisman had with Fed Vice Chairman Stanley Fischer.
Earlier this week, New York Fed President Bill Dudley called the case for a September rate hike less compelling. Would you agree with him?
I think it's early to tell. I mean, the change in the circumstances which began with the Chinese devaluation is relatively new, and we're still watching how it unfolds. So I wouldn't want to go ahead and decide right now what the case is, more compelling, less compelling, etc.
I didn't get a chance to interview Bill. So my question to you then is, did you find the case for September previously to be compelling?
There was a pretty strong case, but it was not a conclusion yet. It was a case.
Let's talk about some of the factors that have been out there. First of all, how do you process the recent market volatility? Someone blamed it squarely on the Federal Reserve and their policy, and this hint that perhaps some accommodation could be taken away. Do you connect the dots from Fed policy and possible withdrawal to the recent market gyrations?
No, I think there were things happening abroad, particularly, which had a significant impact, and that's where I'd start looking.
You talked about the Chinese devaluation. That combined with lower commodity prices and a stronger dollar, all of that, is it your sense that this would reduce U.S. inflation in the months ahead?
Well, if the relatively small depreciation which happened with the Chinese devaluation, with the relatively small appreciation, it'll have some small impact, but I think we've still got to wait and watch and see how this turns out.
We got some PCE numbers this morning, 1.2% on the core year over year. Where is your level of confidence that we're moving back towards the 2% target?
My level of confidence is pretty high, because we're looking still at a period in which we've had significant reductions in energy prices, oil particularly, and we still got the changes in import prices working themselves through the economy. So we've got factors which will go away in a while that are keeping the rate down.
If those factors are transitory, and you have confidence that they're transitory, should that then not stop you from taking action on rates because you are confident that these will go away?
Well, I mean, you know, that's the case that those who want to move now make, and then others say, well, be sure, we don't have a whole lot of inflation going on, so we don't have to move immediately. Those are the two sides of the argument that is taking place. It's not an argument, it's a discussion.
Do you see dangers of remaining at the zero lower bound too long? And do you feel those dangers are increasing?
We haven't seen much evidence of those dangers increasing. We're obviously watching them very carefully because we're being told all the time that they're there, but we haven't seen them in a major way. I think there's another case. This economy has come back to something close to full employment. A large percentage of people believe that inflation will return to the target range of target of 2%, and the economy is working pretty well. In fact, you see that all the time. You see that particularly in the ability to absorb unemployed, which has been going on steadily for 6-7 years. that we're getting back to normal, and at some point we'll want to show that by beginning to normalize interest rates.
When you look at this market volatility, though, is the market volatility itself give you pause and influence the process of making that decision?
If you don't understand the market volatility, and I'm sure we don't fully understand it now, there are many analyses of what's going on. Yes, it does affect the timing of a decision you might want to make.
And so it would be a process of letting things settle down a bit before you came to a conclusion.
Yeah, but I think they could settle fairly quickly. There is that possibility, and we'll know that they've settled down when they settle down. And
I mean, it's sort of interesting the last couple of days. You had this huge, I mean, our research showed that we moved 10,000 points in the Dow, but some of that was up and some of that was down, and it seems like a lot of sound and fury, doesn't it?
Well, it was a reaction to something which had the potential to be very big and which we're still looking at. China has become the second largest economy in the world.
How does a Chinese economic slowdown, in your estimation, how will it affect U.S. economic growth?
The direct effect is reasonably small on our exports. It's not very big. The concern is that if there are a lot of countries influenced by trade with China. China is a major trading country. East Asia particularly is associated with that. And the question is whether interactions among those countries will amount jointly to something that would have an impact on us.
Stan, when we had a chance to chat in February, you were fairly blunt, as sometimes you are, said it's time to raise rates.
I said that?
You said that. I can get you the quotes, but my guess is you wouldn't disagree. Do you still feel that way?
I think we're heading in that direction. What's happening in particular with the labor markets, and we'll have to see if that continues when we get the data for next week, has been impressive, and the economy is returning to normal. We're not certain we're there yet.
So I think everybody's going to want to know an answer to maybe a more direct question, if you don't mind, which is, September, when I hear you talking, is still alive as a possibility for raising rates.
We haven't made a decision yet, and I don't think that we should make a decision. We're dealing with something which happened about 10 days ago, particularly the change in the circumstances. We've got, a little over 2 weeks before we make the decision, and we've got time to wait and see the incoming data and see what is going on now in the economy.
I think it's fair to push back on that, Stan, and say it's a monumental decision. You haven't raised rates in 9 years. Should it really depend on the data in the next 2 weeks?
Well, we've got to take data into account. Those are the only things we really have, that in our economic analysis. If a decision is close, it will be influenced by data that come in recently.
Wouldn't you think there would be an overwhelming case, though, in one way or the other? That you would be sure and confident that, look, there's this, unimpeachable case that it's time to go forward?
When the case is overwhelming, if you wait that long, you'll be waiting too long.
So it's always a bit of a confidence.
There's always uncertainty. And we just have to recognize that we'll have to make a decision in the face of considerable uncertainty, but in the knowledge also that we're beginning a process that we anticipate, when we do it, will be relatively slow, and that the first move presumably will be from 0 to 25 basis points to 25 to 50, which means that our interest rate will still be below the British rate, and they are regarded as doing quantitative easing, et cetera, et cetera.
Right.
So we're not moving from a wonderfully, extremely expansionary monetary policy to a tight one. We'd be adjusting the knob slightly, and we'll probably wait a while before doing something else.
And what about concern that what the market would do is immediately price or bring forward the whole trajectory of rates, and so that rather than looking at just a 25 basis point increase in the borrowing cost for corporations, you're looking at a much larger one?
Well, we have to consider all the possible market reactions. The market anticipates now a lower, or at least recently, a lower path for interest rates than the committee does. So we expect when this begins, there may be some adjustment, but we are doing our best to make sure that the market understands and everybody understands we do not intend doing a rapid rate of increase. We can't promise that won't happen. It'll depend on the circumstances, but our assumption is it's going to be gradual.
I think it's a good place to leave it. Stan Fisher, Vice Chair of the Fed, thanks for joining us.
Thank you, Steve.
Well, so the Fed's clearly not made up its mind on whether it will hike in September. That's the key takeaway. Let's take a break on that note. Thereafter, Governor Rajan.
We've cut interest rates 3 times this year, and we're still in accommodative mode.
Well, Governor Rajan at Jackson Hole on what should the Fed do with rates and what he will do.